Hello, everybody. Hey, hello, Mr. Carl. How you been doing today?
Hey, Jarek, I am excellent. How are you doing?
Uh, okay. Aside of being sick like hell, I am doing perfectly fine, right? And I'm so excited to be honest with you because I believe that 2019 will be an amazing year, and especially for whoever wants to work with us and whoever is participating. Thank you very much for joining us. And the way how I'm going to see it is, Carl will be talking and educating everybody who are attending and watching this presentation about investing in the US, advantages, disadvantages, some examples for educational purposes, right, Carl, right? And then our goal is definitely to find the synergy and help you guys to take an action. And if you will have any questions about anything related to investing with US properties, and working with Carl and Street Smart Real Estate Investing team, we will be definitely brainstorming about that at the end. So, Carl, simple as that. Who you are, what you're doing, and how you started real estate investing. Let's go to the chases right away. We do not want to talk about ourselves. Our goal is to help people who are attending today, right? And just can you introduce like 30 seconds, man? Shorter than elevator speech.
All right. All right. Yep. My name's Ewing, and I am obsessed with real estate investing in the US. I've been doing it full time for the last 2.5 to 3 years. Got my first deal about in 2009 in Las Vegas. And currently what I'm doing is my business is solely based in Houston. I'm actually in Houston right now. And so my whole business is buying and selling real estate in Houston, Texas. And I'd love to share what I do and some of the things that I've discovered as a Canadian, because I still live in Calgary and I run my business from Calgary. So I'm here to help you guys figure out the US real estate investing game from Canada.
Okay, perfect. And you can run successful real estate investing business remotely. That's one of the messages, right? You don't have to be in the trenches all the time, which you have a partners, right? Very nice fellow next to hiding behind the
Yes.
Yeah. So guys, the way how we are going to do it is very, very simple. Even I'm sick like crazy, I will be very happy to answer all the questions. So if you have you see the chat, you can chit chat and have a regular conversation with everybody. Q&A is simply if you have a question, and that is only for the questions. And then the polls and handouts, we don't have any handouts, but polls will be some pop-up offers and everything. So I would like to be as interactive conversation. So Carl, can you switch? Let's jump on it, and then we will see how we can help people to be successful in 2019. How does it sound?
That sounds excellent. Clint's going to help me switch my presentation on right now.
Sure. Can you see, guys, the presentation? Let me know. Hello, Karen. Nice to see you. Long time I haven't seen you. Lindy, Clint, Chow, Lean, Chris, and let's bring more. Joe. Okay, perfect. It's all yours, Carl. Can you see the screen, guys? Can you type it in?
Okay. Everything looks good?
Let's type it. I can see. Chris, thank you very much, Chris. Yep, let's go for it.
All right, yeah, thanks everyone for coming on tonight. I know there's a million other places you could be. So Jarek and I are really happy that you can spend some time with us learning real estate. Him and I are sure passionate about it, and so we want to share our knowledge with you. So yeah, tonight I'm going to talk strictly how to invest in the United States, or how the strategies I prefer to use investing from Canada in the United States. All right. So Jarek, do you want to talk through this, or what do you want to do with your slide?
Let's skip it. To be honest, I don't want to talk about myself. Let's not waste the time. Okay. Everybody who knows me, they should know, right?
Okay. All right. Well, I kind of covered that, so I'm just going to pass through this too. And we did another presentation last week, so.
Sure.
Okay. So the strategy I'm using right now in the U.S. I'm thinking that we may be there's a risk of heading into a downturn across the US in most markets, maybe even a recession. And so my company has switched our strategies in the last 6 months. So I'm going to talk to you about what we are doing in the US, just to protect ourselves, make sure that we're making smart investments. And also, I hope that you can take some of these strategies yourself if you choose and implement them as well, okay? So before I get started, the typical legalese, but you know, I'm not an accountant, I'm not an attorney. This is just me sharing what I do, what's worked for me, and for educational purposes. I hope you can take some nuggets out of this and implement some of this into your own businesses, investing in the US. But I do strongly recommend, you know, make sure you talk to an attorney, both in the US and Canada, and same with an accountant, to make sure you're set up in a safe way moving forward, because it is a risk out there with real estate, as you all know. So just be careful and make sure you're using professionals. Okay, so the question I have asked most people is, are you happy with how your investments are performing right now? And a lot of you guys, obviously, if you're on this call, you're already real estate savvy. You like real estate and you see the benefits. But there's a lot of people out there that are seeing some pretty scary things in the market right now and are just looking for better ways to grow their wealth, hopefully get their time back, and, you know, eventually get to financial freedom and all the things that real estate can buy. And so I like to show this just as a comparison. These are US CD rates that I got in November. And these are the highest rates. So I Googled the highest CD rates across the country, and the best you can do is about 2.9% on CDs. So I don't know how you grow a future with something like this, but I also wanted to share these stock market slides here, just because I know a lot of people invested in the stock market, and there's nothing wrong with investing in the stock market, but I'm here to show you some of the benefits of real estate. And, you know, the thing that we love about real estate the most is that you have your money secured to a tangible asset, a hard asset that you can touch that has value. And the cool thing with real estate is people are always going to need real estate, no matter what the market does, no matter how much chaos there is, people need housing. And I feel really secure and confident in the fact that that's what the business that I'm in. So I pulled these headlines from basically from August to December. Most of it's talking about the stock market, especially in the US. And to me, it's looking pretty scary. Since then, the headlines have been getting even more worrisome as far as stocks go. And so if you're thinking of maybe diversifying or even getting out of the stock market and into real estate, I hope that some of the info I share can help you make a more informed decision. And I probably don't need to show you guys this, but in the past few months here, since November, really, you can see this is the S&P 5,000, and you can see I'm just trying to read the graph here from afar. It's like since, I guess, pretty much November, things have kind of gotten really scary and fluctuating quite a lot. And so I know a lot of people are looking for alternatives, okay? So I'm not, as I said, I'm not here to scare. I just want to make sure everyone's informed and knowing what other options are out there. Okay, so I'm going to introduce two key concepts tonight: private lending on real estate and owner financing. And these two are very similar. And we work with people basically as private lenders. And I'm also hoping to teach people how to owner finance properties. And whichever strategy you feel is the best for you, or maybe none of them, but I'm going to inform you on both of them because they fit beautifully together. Okay, so private lending on real estate. This is another word for saying investing in real estate notes, okay? And what this is basically is you're lending money to a real estate investor who is purchasing an investment property. And that could also include repair costs and holding costs and things like that. But you're basically funding a real estate investment deal for another investor. And it's a more passive investment strategy because you're basically becoming your own bank, okay? And when you're doing this, a mortgage or a note is created. And the note is basically the terms of the loan, the agreement that you and your investor or borrower are agreeing to. And this loan is secured to the property, okay? So just like your bank mortgage, it's secured on title, and the house is the collateral. And if you do it correctly, the property should be worth significantly more than your loan. and that's how you create security and safety. Okay, so with our program, with our owner financing program, we're borrowing from private lenders over 5 years. Okay, and unfortunately for Canadians, you can't lend out of your retirement accounts, as far as I know, on U.S. real estate, but we allow Americans to do that as well. Okay, so I just wanted to clear up a little bit of terminology. You'll hear private loan, private mortgage, private money mortgage, note, promissory note. All these things are often used interchangeably. So if you hear these things out of my mouth, they all basically mean private lending, you being the bank and lending on a piece of real estate, okay? Okay, so this is why I love private lending. And it's funny, my partner Clint and I were at a real estate meetup in Houston 2 nights ago, and they actually had a panel talking about private lending. And they had 4 real estate investors who have now become private lenders themselves. And so it seems to be a common thing for really sophisticated investors, real estate guys. They start actually lending on real estate themselves as well as buying properties. So they end up navigating to this route, even though they're extremely well versed in buying and selling property. Okay, so as a private lender, you can expect or plan for 2 different outcomes. Plan A is what we would expect, is you're collecting monthly payments from your borrower, right? Just like when you're paying your mortgage, you're paying monthly. Okay, so you can expect your borrower is going to pay you either principal and interest payments or just interest payments month after month. And that creates monthly cash flow that really doesn't have a lot of extra work or headaches tied to it. Okay, plan B, you could call the backup plan, or even the worst case scenario. And that is if your borrower stops paying, or they pass away, or their business goes belly up, or something like that. Something causes them to stop honoring the commitment that they made. And what happens is then you basically take back the property. And if your loan is set correctly, then you have a property worth 30 to 50% more than the amount of money you loaned out. Okay, so it's almost a strategy in itself, because plan B can actually be more lucrative than plan A. So I know I get this a lot from people that are new to lending on real estate. You know, what is my security? What can I expect to get? And basically it's 2 documents that secure your loan to the property. And number 1 is the note or promissory note. Okay, and you can consider this basically just the promise to pay. So this is the document that states all the terms and conditions that you agree on with your borrower. So this is your interest rate, your loan length, the loan amount, something like, you know, late penalties, things like that. Obviously what the collateral is securing your loan, and anything else that you want to agree to with your borrower. It can be anything really. It's just between you and your borrower, and it can be added to the note. Okay, so this is the contract, and this is something that's private between you and your borrower. It's not a public document that's recorded in public record. But what is recorded publicly is the deed of trust. Okay, this is your mortgage document, and this is basically securing the collateral for your loan. Okay, and so this is registered with the county typically. It's in the county records. You can view it online, and as long as it's stamped and dated by the county, that means it's recorded, and that's your security. Your loan is safe at that point and tied to that collateral, that property. Okay. So that's private lending, and I want to show you how this fits with an owner financing model. So there's basically 2 roads you may want to take as a Canadian investor. Okay, so you could take the private lending route, which is more passive, and you're loaning on real estate projects. Here's an example of a project that you could loan on, or you could be the investor and do this strategy yourself, okay, with an actual property that you're finding and acquiring. Okay, so I'm going to teach you kind of both ways that you can get involved, and this is the more active route, and this is the route I take personally. Okay, so it's called owner financing. A lot of you have probably heard what owner financing is. Another word is seller financing or vendor financing, owner or seller carryback, things like that. But it's all basically the same. It's when the owner of the property sells the property to someone who wants to buy it, and they offer financing themselves for the buyer. Okay, so the new buyer gets to pay off the property in installments. Okay, and so it's really just private lending again. In this case, though, you own the property, and your buyer is paying you interest payments. Okay, so it's really the same thing as what I just explained, except you're the property owner. Okay, so this is how it works. So we're constantly hunting for discounted properties all over the greater Houston area, but you can do this in any state, not just Texas. The laws might be a little bit different, so I do recommend you talk to an attorney in the state that you're wanting to work in. But owner financing, as far as I know, you can do it in any state. So we're buying a house at a deep discount, typically 50, 60, 70 cents on the dollar. Obviously, we'd like to get it even cheaper than that. And then we're financing the purchase of that property with our private lenders. Okay, so I work with private lenders myself, and they help us acquire these properties by lending the monies to us. Okay, just like I explained. So I'm the borrower, and my lender's my lender. So we buy the house, and then we immediately turn around and sell it again with owner financing. And typically, these are our buyers are people that can't qualify for a traditional mortgage. Okay, so there's a lot of scenarios that people can get in, but we're typically looking for someone that's had some bad luck, been down on their luck, but they've kind of got past it, and they've got a solid, stable job, a stable income, and they look good as a buyer. We feel that they're going to be able to make their commitment to pay us every month. And this could be people that don't have citizenship yet, people that have recently been foreclosed on, or have had medical issues, because as you know, in the US, the medical bills can be very hefty. And so it can cause people to get behind and get in trouble with their credit. An example of a lady we're working with right now, she got flooded in Hurricane Harvey, didn't have insurance, and then she used her own money to pay for the whole rehab to get her house fixed up again, and the contractor walked off with all of her money. And so now she's going into foreclosure, and her credit is trashed. And so she's going to buy a house from us, and we're going to finance it to her. So she just had some awful bad luck that was none of her fault. So that's a typical buyer we work with. Okay, so then we're lending basically to our buyer, and we structure the payments that our buyer is paying us so that what they're paying is the same as what the property would rent for. Okay, so this is the key to the whole thing, is that principal, interest, taxes, and insurance, when you add all that up, it's going to be the same as rent. And this is the value of this. And the reason it's so valuable is because I'd say probably 9.5 out of 10 people, if they had the chance to own a property for the same price that they would to rent it, they would choose to own over renting. Okay. And so we're able to actually sell our properties for a higher price because we're adding this value. We're adding the financing with the property, and that's extra value. Okay, they call that equity resizing. Okay, so we value the sale price, or we come to the sale price when we sell our homes. We start with the rent, and then we back the calculation up to figure out what we can sell it for, and I'll show you how that works. So is there any questions so far? Is everyone on board? Anything there, Jarek? Okay, so we're good. Okay, so when we're talking, I call this the owner finance value of a property. Okay, so you can have a comp value that your realtor will pull for you. It's a CMA, comparable market analysis, where they'll look at other sales in the area that are similar type of house, age of house, size of house. Okay, so there's a comp value. There's a tax assessed value that the county uses for taxes. There's the appraised value, all those different ways of valuating a property. We're not really concerned with that here with this strategy, because all we're caring about is if our buyer is going to make a payment which is the same as rent, how much can they afford to borrow? And that's going to be their purchase price. And it doesn't really matter what the house value is at, okay? Because the driver here is that their payments are the same as rent. And it's kind of the same as when you buy a car. The last car I bought, I remember I was mainly more concerned with what my monthly payments were going to be. I wasn't as worried about the sale price was. I was more about, okay, well, can I afford this payment? And I think most people are similar. And this is how they're viewing these homes. Okay. So I think the best way to show you guys this strategy is to use a real life example. And this is the house that we just bought, 4001 Pick Fair in Bay Cliff, which is, I guess you could call it a suburb of Houston. Okay, so you can see by the photos, these homes are, I guess, lower end homes. These are in rental neighborhoods. We're trying to buy homes where the rents are high compared to property values. And you can see this one doesn't look pretty by any means, but these are the kind of homes that we like that fit this model really well. Okay, so we bought this house for $52,000, and yes, 52. I know that's unheard of in Canada. It's a 3-bed, 1-bath, 912 square feet, so it's a tiny little thing. And we figured that it's probably going to take the buyer, so our owner finance buyer, about $10,000 to get it up to snuff. So it's livable, but they probably want to put about $10,000 into it. And we don't do any of the repairs typically. Okay, so that's the other beauty of this strategy is we're not typically putting a lot of money into these homes. And it rents for $1,000. Okay, so we did some rental comparisons and to see what other similar homes rented for, and we figure this would rent about $1,000 a month. Okay, and then taxes are $80 a month, and insurance is about $65. Okay, so now that we have this information, and I'm just going to summarize it here. So we purchased it for $52. Okay, our closing costs are going to be about $2,000, or they were about $2,000. I don't know the exact number here, but and then we spent about $2,000 per deal in marketing for a new buyer. Okay, so we're running Facebook ads, which work extremely well for this. We also have put banners on every one of our properties, and that gets a lot of calls. Facebook Marketplace, you can use bandit signs, Craigslist, things like that. And then we put in about $3,000 just to get it cleaned out from the previous owner and presentable. Okay, so in order to handle all these costs, we actually borrowed from our private lender $59,000 for this house. Okay, so they lent us $59,000. And these are actually Canadian lenders as well. They're living here in Houston, but they're Canadian. And we pay 8% interest only, okay? And we pay them every month. And the loan term for this is a 5-year loan, okay? And the reason that it's 5 years versus a short term is obviously we're owner financing these properties for a longer term to our buyer. So we need a longer borrowing term with our lenders, okay? So in this case, they're earning $393 a month. And our private lenders get first lien position, okay? So you can use your own cash for these kinds of deals as well. Obviously, you can buy it with your own cash and then owner finance it. Or if you find people that want to lend, like I was explaining, then they could fund your deal and you pay them and they get first lien position, okay? So they're super secure because they have a loan to value of 57%, okay? So the loan, what a loan to value is, if you don't know, is the amount of loan divided by the value of the property, okay? And this is loan to owner finance value. So we actually are selling this one for 103. So 59,000 divided by 103 is 57%, okay? So they have a lot of equity behind them to secure their spot as a lender, all right? Okay, so like I said, we're selling this property for 103,000 owner financed, okay? And we're collecting at least 10% down, all right? So that's 10,300 in this case. And so we're raising the interest rate that we're charging our buyer, okay, to 10%. And that's over a 30-year loan, all right? So there's a spread in the interest rate between what we pay the private lender and what we're charging our end buyer, okay? And so our buyer's loan payment is $813 a month, but when you factor in taxes and insurance, it works out really close to $1,000, which is what this house would rent for, okay? So I'm not sure if you guys really want to dig into numbers, but I do have a slide here I'll go through so you can see the exact calculation on how you'd figure out what to sell these homes for, owner financed, okay? So it starts out with the rent, which is $1,000, okay? And then we're subtracting the property taxes, which is $80 a month, and then insurance, which is about $65 a month, and you're left with $855, okay? So that amount is what our borrower has available as a loan payment to us, okay? So then once we know what their monthly payment is, we can figure out what their loan is. And I just use a financial calculator. Okay, so that blue box there, I just took it right from an app I use on my phone. So you just plug in what your payment is monthly, which is $855. And then we're doing this for 30 years. This mortgage is a 30-year mortgage, so that would be 360 months. And then it's a 10% interest rate, and then it solves for the loan amount. Okay, so that's 97, close to 97.5. Okay, so that's the loan that we're going to lend to our buyer, or that's what you know what I mean, the financing. And their payment's going to be $855 at 10% for 360 months. And then we need to figure out, okay, well, we're also going to charge a down payment. Okay, and so we need at least 10%. So I take that loan balance of 97.5 and I divide it by 90%. Okay, and then I also subtract 50% of the rehab costs, because our new buyer is going to also have to do some repairs. Okay, so I said there's 10,000 in rehab, so 50% of that's 5,000. Okay, so when you subtract that, we get 103,000 is our owner financed value of the home. Okay, and that's our sale price that we're selling this property for. Okay, so does that make sense to everybody? Any questions there? I can't see the question box, so. Okay. Okay, so just a quick summary. We bought it for 52. We're borrowing 59, and we're selling for 103 with owner financing. Okay. And just so we're really clear, I made a little infographic here as well. And basically, so we've got our private lender, right? They're lending us the money to buy the home and cover the closing costs. Okay, so they take first lien position, and this is the same as what your bank would take typically. Okay, first lien. And then we now own the property. My company owns the property, or if you're doing the strategy, you would now own the property. Okay, then you're finding a buyer and you're selling them the property immediately. So it's not a rent to own. They're buying it immediately from you. Okay, and so you're creating a new loan for them, and that takes second lien position, and they're paying a higher payment than what you're paying your lender. Okay, and that's where the spread is for the investor. Okay, so you're taking the difference between what your buyer's paying you and what you're paying your lender, and that's your monthly cash flow. Okay, and meanwhile your lender is getting equivalent or close to equivalent cash flow as well. Okay, so we're both parties are being lenders in this deal. Okay, so it's kind of cool.
You have a question.
Oh, there's a question.
Karen says, well, she asked, how much are you making on this deal? And
I can show you.
then she said it looks like a variation of RTO.
It is, yeah. So how much are you making on this deal? I can show you in a second, Karen. It does look a lot like rent to own. One of the reasons that we do this strategy in Texas versus rent to own is that there's a bunch of laws that were passed in Texas that make rent to own extremely difficult. There's a lot of red tape and paperwork, both for the tenant buyer and the investor. And most people here don't use that strategy anymore. But owner financing, I guess you could say it's a replacement or an equivalent to it. I like it regardless, even more than a rent to own.
Yeah, rent to own is.
I think part of that's because the down payment's typically higher.
Yeah, rent to own is much more cumbersome, much more legalities, much more what if strategies. This is very, very straightforward. Lending wraparound mortgages, as you call it here, or yeah, much easier, simple.
Yeah.
Yeah.
Okay, so what we're creating here, which I really love, is it's a triple win. Our private lender wins because we're providing them with a stable monthly income, cash flow that they don't have to have all the headaches of, say, being a landlord. There's none of that. They lend the money and make the loan, and then they sit back and collect payments. Okay, and a lot of people love this out of their retirement accounts as well, because they can grow their retirement faster. Our buyers win because we're helping good people that have stable jobs. They've just had some bad luck. We are helping them get into a good home and start a life. And then we win, of course, because we're getting a good, reliable cash flow month after month as well. And we also don't have all the headaches of being a landlord. Okay. So the private lender benefits. So in this case, they're making 8% interest only. And the cool thing about this is that a lot of times when you're working with a private lender, say you're a fix and flipper, right? And you're lending on a fix and flip deal. Well, that project might take 3 to 4 months, right? And then there's typically at least a month, I would say, in between projects before you can lend your money on the next one. Okay, so you're going to probably have 2, 3 to 4 months out of every year where your money's just sitting there and not earning you any money. Whereas in this case, it's a longer term loan. So every single month, your money's working for you. Okay. The other benefits of it is that you're getting first lien position, where I know a lot of cases as a private lender with rehabs, again, a lot of people are taking second lien position. And I mean, it's a great opportunity to lend, but it's a little bit more risky than a first lien. Okay. And of course, if your borrower doesn't pay, well, then you're acquiring an asset, the property, which as long as you're setting up the loan right and doing your basic research ahead of time, it's worth a heck of a lot more than your loan. Okay. So you can turn around and sell the property. You can continue owner financing. You could rent it out. You could fix it up and then sell it. There's a lot of things you can do with the property if the worst case were to happen. Okay, so I believe it's incredibly stable and a safe way to invest as long as your loan to value is set up correctly. And that's also why we're putting ourselves in a position as a lender too. Okay, so here's a look at our profits from the investor's perspective. Okay, so in this particular deal, we collected a down payment of 10%. Okay, so that's going in our pocket up front. And then you can see here, our buyer's paying us $855 a month in their principal and interest payments. And then we owe our lender $393 a month. Okay, so the spread here is $462. So we're making $462 in cash flow every single month on that, as well as the down payment. Okay, and it just depends on the deal. Sometimes the private lender is making a higher monthly cash flow. Sometimes the investor makes a little more, like this case, but it's pretty close to the same, most deals that I analyze. And I think the biggest thing, and I don't know how many of you guys have had rental properties or not, I've had some rental properties where we even had property management in place, and there's just always repairs. It seems like you're always having to put a big chunk of your rental income aside for the AC guy, the roof repair guy, when the hot water heater goes out. And so all of that cash flow, it's not your cash flow necessarily. You got to keep a big chunk of it for these people. And then you've also got the headaches, whether you manage or not, it depends, but the middle of the night calls and all those things that everyone talks about, the headaches of being a landlord. With this, once you make that loan, there's none of those problems because the buyer owns the property from day one. Okay, so any repairs are their responsibility. And the cool thing is with a lot of these homes, buyers often will fix them up. Okay, so your collateral is actually increasing in value over time as your buyer is, painting, fixing it up. Sometimes they do major renovations on the homes, and so your equity position and your security in your loan is actually increasing. Whereas if you have tenants, you're the only one that can increase the value and fix up the property. Okay, so here's just a little chart that I got from Mitch Stevens. He's an investor actually who taught me this strategy. He's done thousands of these in Texas as well. So things like maintenance. If you're a landlord, maintenance is your problem. If you're a lender, whether you're the owner finance person or the private lender, it doesn't matter. It's not your problem. Taxes and insurance, your buyer is paying those, okay? You don't have to worry about liability insurance. If, there's no tenants to move out. If your buyer were to back out, you take the property back, okay, and do it again. Entry fee, you're going to get the security deposit, obviously, but here you're getting a down payment, okay, which is a way bigger chunk of money. And then the biggest thing I think is the mindset. So I use the equivalent of, when you're renting skis or a snowboard and you encounter an area that has rocks. If you're on a rental, you're probably going to be like, whatever, let's just go through. It's just a rental, right? Let's just go over it. Whereas if you just bought a brand new set of skis or snowboard, you're not going to go on those rocks, right? You're going to do everything you can to avoid them. And that's the same mindset between a tenant and an owner finance buyer, because they have pride in their home. And so in most cases, they're going to take care of it a lot better. Okay. Maybe one of the downsides that people would say about this strategy is there's a lack of appreciation when you're owner finance. Whereas if you're a landlord and you hold a property long enough, you're going to get that appreciation, right? I dispute that, because when we're buying these homes, we're actually creating our own appreciation. And you could see we paid $52,000 and we're selling it for $103,000. And if, say, for example, our buyer were to default later on and we put a new buyer in, we could actually extend this for many, many, many years and basically create our own appreciation right off the bat. Okay. Depreciation is one advantage to being a tenant that we don't really get as a lender, but I like it a lot better. Okay. The reason that we put so much focus right now in this strategy is because we believe it's more of a recession. We call it recession positive business model. Okay. So if we are encountering a recession soon, which I don't know, no one has a crystal ball, but there seems to be some signs of markets shifting. And it's happening here in Houston. I'm seeing it happen in Calgary. It's happening all over. So the thing with a recession is, and this is what's happened during the last recession, is that lenders start tightening up their lending criteria. Okay. So they're making it harder for first-time home buyers to qualify for loans. Then you're getting a wave of foreclosures, right? You're getting people that lose their homes to foreclosure. They're going into bankruptcy. Tax foreclosures are increasing. Okay. So you're getting all these people that were homeowners that are suddenly now in the rental market. Okay. So that puts a pressure on the rental market, and rents typically go up because of this pressure. So in a recession, rents are actually increasing. Okay. So what does this mean for our model? Well, we're basing our sale price. We start with rent, right? And we're backing it up until we find our owner finance sale price. So if rents go up, we can actually sell our properties for a higher price as the rents go up. Okay. And the really cool thing is while everyone else's property values are dropping, ours are actually rising as long as we're using this model. And I think that's pretty neat. And if we do have to foreclose on a buyer, for example, the rent would go up after that and we could raise our price then again. Okay. And one other thing I wanted to say about comparing owner financing to other strategies is that we also have been wholesaling houses. Okay. So we get a property under contract, and I don't know if any of you guys have wholesaled, but you're typically, you're typically getting a property under contract and then selling that contract to another investor and taking $3,000, $5,000, $10,000 out of the deal, right? With this strategy, you're getting that same amount up front as a down payment, but then you're also capturing all of that interest from your buyer. Okay, so instead of just losing the deal, you're able to get so much more in long-term profit from a deal like this, instead of just taking that contract and selling it and you're done with the property. And so that's something that we really like. It was a mind shift for me, is that, wow, we can make that same wholesale fee and then get all the interest. So, all right. So I'm just going to go through the process for you guys, how it works. So first of all, we're finding a good deal and we're going to put it under contract. Okay. So the neat thing about this strategy is we've been able to buy properties from wholesalers and the numbers actually work. Whereas a lot of times I find with wholesalers, when we were doing fix and flip and things like that, the numbers never seem to work. And so I would just be deleting wholesaler emails. But with this model, you can buy a little bit higher and it still fits the model. Okay. So maybe you don't have a lot of money to market for homes, or you don't really know how to market for good deals. Well, you can still buy properties from wholesalers and probably even real estate agents that would fit this model. Okay. So it makes it easier to get the property. And then what we do, this process is more when we work with private lenders, but we then send out an information package to our lenders, and they get to see the deal and all the loan requirements. Okay. And then if they like the deal, all right, then if they are in the States, then we get to take them to the property and they can have a look around. But otherwise, we have photographs and video walkthroughs that we provide. Okay. And everything here is done with a title company. So if you're just getting started in a market, that's the number one thing you need to find with this strategy is find a title company that works with this strategy. So owner financing, wrap mortgages, which is another name for what we're doing, and private lending. Okay. So if you can find a title company that knows how to do this and an attorney that knows how to do this, and there's many of them out there, your job is so easy because they basically just walk you through the process and tell you what needs to be done. Okay. If you don't have an attorney on your side, I find that then you've got questions popping up and you don't know what to do, and it gets really hairy. But with a good attorney that can guide you through the correct way to get these deals done. Okay. And so then what happens, we typically get our private lender to get the loan documents drafted by an attorney of their choice. Okay. If you're thinking of lending on real estate, I would recommend making sure that you always get an attorney to draft the documents. Don't just accept the documents from your borrower that maybe they've drafted previously or had their attorney do. I recommend getting your own attorney to do that because they have your best interest in mind. Okay. And so they're going to draft the promissory note and the deed of trust for you. Okay. And then typically you would then wire the funds and they'd be held in a title company. Okay. In the escrow account. So as a lender, again, I recommend never wire the funds directly to your borrower. Unless I guess if you know them so well that you trust them, but we always work through a title company whenever funds are getting transferred. Okay. So I recommend just doing it that way. It's just so much cleaner and safer. All right. And so then once all of the title work is done and you know the property doesn't have any pre-existing liens on title, title's clear, then you would just go ahead and close the deal. And what they do is once you sign the lender docs as the borrower, those documents get sent to the county and they get stamped and then they get sent to the lender. Okay. So you need to make sure that part happens. And as soon as you get that stamped document by the county, your loan is secure and safe and tied to that property. Okay. And then, yeah, you've got yourself your first note. You've created your first real estate note and you're the lender on that property. Okay. So as the investor that's doing the owner financing part, it's very similar. So we're buying the house and getting it under contract, and either we're paying cash for the property or using private loan. And then what we are doing is we are running our borrower, we're screening our borrower. So we want to get their credit score, we want to get their proof of employment. So it's very similar to if you're screening a tenant. Okay. We want to make sure that they are going to be able to pay. And they have a consistent job. We also interview them just to make sure that, I don't know how to say, you know how some people, they just seem to be like constantly having bad luck. Just those people that are always down in their luck and down in the dumps, and they just seem to attract chaos all the time, right? We typically try to avoid those people because they're probably going to be headaches. And we also ask where the down payment money comes from, because if, say, they got their down payment money because they just sued somebody, maybe that's not the kind of person, right, that you want to be working with. So we want to make sure we know how they got their money, that they really want to be a homeowner, that they're honest and things like that. So the last step that we need to do, and this is very important, is in the States, they have what's called the SAFE Act. And this was put in place to part of the reason was to protect buyers or borrowers from getting jerked around by lenders who put them in loans that they could not possibly afford. Okay, so we use a residential mortgage loan originator. So RMLO is what they're called, and they're in every state, and they work closely with title companies. Okay, and they actually do the final screening of your buyer, and they make sure that everything looks good. Okay, so this takes any liability off your shoulders as the investor that's selling the property. They give the go ahead and say, yes, this buyer can afford this house and this loan payment. They sign off on it. Okay. In Texas, if you're doing fewer than 5 of these a year, you don't have to use one. If you're doing more than 5 of these deals, you absolutely must use one. But I would recommend using them all the time anyways, because then, like I said, you've got a third party that's basically vetting these people for you, and you're out of the target. okay, in case something were to happen, you already get sued. Okay. And then we set everything up. This is the best part, is we use a loan servicing company to collect the payments from our buyer. They will take tax money for taxes in escrow every month, and then they'll also pay our private lender. So they make sure that everyone gets paid on time, and they collect they collect the money, but they also do the bookkeeping at the end of the year. Okay, so everyone gets a statement at the end of the year showing how much interest they made. So that part of the bookkeeping is also done. So it makes it really easy to keep track, especially if you've got more than one loan. Okay, if you got a whole pile of these owner finance loans, it can be hard to keep track of everything. So they make it a lot easier. Okay. I'm going to just skip this. This is just what we, if you're a private lender and you're wanting to lend on real estate, this is what we provide our lenders. And this is some of the things that you should expect. I guess I'm not skipping this slide, but just to go really quick. So you definitely want to get a comparative market analysis to estimate what the value of the home is. And we also use a rental CMA, a rental analysis, to verify what the rents are in that area, since rent is so important in this strategy. Okay, we're also sharing flood zone information, school district information with our borrowers, just because especially in Houston, flooding can be an issue. Okay, we want to make sure that they understand that we're avoiding these flood zones. And then you need to see the title commitment from the title company, okay, because you want to make sure that there's no pre-existing liens or anything that could come back to either kill the deal or haunt us later on. Okay, and then obviously you're in Canada, so you may not be able to visit the property yourself, but either have someone that you trust go and see the property, or make sure you're seeing photos and videos. Okay, and then if there are repairs being made, I really recommend that you have your investor that you're lending the money to provide a detailed repair estimate. Okay, don't just say, well, yeah, we think it's about 30,000. Make sure that you're looking at that and it makes sense to you. Okay. So I've got a little bit of an FAQ here, and these are questions that a lot of people have asked me in the past that I'm assuming some of you guys might either be asking yourself or have others ask you if you're looking for a private lender. Okay. So number one is, of course, what if I don't get paid? And I talked about this a little bit earlier, but the beauty of being a lender is the fact that if you don't get paid, you get the deed to the house. Okay. If you don't want to be owning a property, if owning a house is not your thing, then maybe being a private lender is not your thing. Okay, because this could be a reality for you. You may have to foreclose on the home, and but if you are into real estate, like a lot of us are, then getting a property worth way more than your investment is pretty awesome. Okay, or the other situation is you basically take, if you're the private lender, you would be taking directly, you'd be taking the payments by the end buyer. Okay, the investor who wasn't making their payments is out of the picture, and now you're getting double the cash flow. Okay, and that's a really cool position to be in as well. Okay, so I mentioned flooding. So what if the house floods or burns down? Okay, and this is a concern obviously for all parties involved. Make sure, and we make sure, that there's insurance that's covering the first lender, the private lender in first lien position, the investor that owner financed the house, they need to be on the policy, and then of course your end buyer. They all need to be on the insurance policy. Okay, if anyone's missed, it's very dangerous, and you could lose your investment that way, or your loan. All right, and then flooding in Houston. Obviously, this is a major concern. If you guys remember Hurricane Harvey in August of 2017. The great thing about what happened in Hurricane Harvey is it was an 800 to 1,000 year flood. So we have a really good idea of what areas will never flood, and we focus on those areas. So no matter what market you're in, I would do a little due diligence, talk to some realtors and contractors and just people that you trust that live in the market, and just ask them, what are the dangers? You know what I mean? If you're in California, maybe it's wildfires, maybe it's earthquakes, but just make sure you're aware of what the potential risks could be, and that make sure that there's insurance and that you're not getting involved in properties that could be in harm's way. And then what about a market crash? What if home values drop while I'm the lender on that property, or while I'm owner financing this property? Okay, and the answer is, well, this is exactly why I believe that this is a good strategy to be in. Okay, is if this happens, I believe we're in a lot safer position than, say, if we're fixing and flipping or something like that. Okay, so I made this presentation a while ago, so it's talking a lot about Houston, but you can just see here that I'm actually going to go to the next slide. So this is the home price index since 2006 to 2018. Okay, so you can see that the U.S. on the right there, U.S. as a whole took a fairly dramatic plunge back in 2009, 10, 11. Okay, Houston, that's the reason we're investing there. It hardly saw it. Okay, if you're comparing Houston to other markets in the U.S., so we've got in the middle at the top there, we're comparing it to this one was Los Angeles, San Francisco, and Seattle. So the West Coast cities. You can see that they took a massive drop in home value in the last recession, whereas Houston, the little light green line at the bottom, hardly saw it. Okay, looking at Vegas and Phoenix, which are markets that a lot of Canadians do like to invest in, but if we're sitting at the top of that market, they took a massive hit. All right, and again, Houston didn't really see that. And then at the bottom left, I'm actually comparing Dallas and Houston. Dallas did see it a little bit more than Houston as well. Okay, so that's why I love Texas, because the markets here are very secure and stable. There's a lot of jobs, a diverse economy. It's not just oil anymore here in Houston. There's a lot of in-migration, a lot of people moving here, looking for jobs and housing. Obviously, they'll need housing. Okay, and because it didn't really suffer in the last recession. Okay, the other thing you want to notice is when you're looking at these curves, I'm just going to go back, but I would say it took about maybe 4 or 5 years for the market to drop and then rise again. Okay, so it seems like we're seeing about a 10-year cycle in the US. Not to say that it would be like this in the future, but if this is a 5-year deal you're doing with your private lender, you would hope that the market's going to start going up again. So even if the market did drop during that 5 years, things are probably going to be closer to recovering. Okay, just the way that the timing went on the last one. So that's why I feel secure with this. Okay, and then the be-all end-all for protecting yourself against a market crash is, of course, your loan to value. Okay, so you want to be in on one of these loans so that you're safe and you have enough equity behind your loan so that if there was a market value drop, you're going to be okay and there's still enough equity to cover your loan amount. Okay, and so that's why when we're borrowing our deals or borrowing on our properties with private lenders, our loan to value is going to be somewhere between 50 and 70%. Anywhere higher, and I think your lenders, maybe 75 is okay, but anywhere higher, the lender's putting themselves in a fairly risky spot if this were to happen. So if you're thinking of lending, make sure you're watching that loan to value. And if you're thinking of doing these owner financing deals like this, where you're borrowing private money from someone else, just make sure that you're putting your lender in a safe position and not borrowing too much, because it's going to hurt you and it's obviously going to hurt your lender as well. Okay, so I just wanted to talk a little bit more about a free online training that I have. My website's called Rockstar Private Lending. Okay, and I teach people the art of lending on real estate. Okay, how to be a private lender, and you can do this in Canada as well. It's a little bit US specific because that's what I know. But I recommend, if you want to learn more about how to be a private lender or even how to borrow private money and from that lending perspective, you can go to rockstarprivatelending.com, and it's absolutely free. There's 4 videos on there, and I just go through all of the aspects of being a private lender, the benefits, the risks, things like that. Okay.
Just what I want to add it is everybody who is attending and will be participating that, you will have a follow-up email sequences with all that information, and we will also receive all the videos and everything, right? So do not worry about that, guys, right? We want to make sure that as long as you will be willing working with us, we will take care of you, right? So
Absolutely. I'm just going to go to this one, Jarek, and you can talk a little bit more.
Okay, so this the steps to follow up. So what we are looking for, Carl, what kind of perfect investor would you like to work with, right? Let's be to the point, right?
Sure. Yeah. Well, if you want to work with me and my program that I have in Houston, we are looking to work with people that want to be the first lien private lenders. And so we're looking for folks that understand real estate. They maybe don't have a lot of time to go and do the deals themselves. Like I was showing you, you maybe don't want to be the owner finance person. So we work with a lot of people like that want to benefit without doing all the hard work. On the other hand, if you do want to do the hard work, I would love to help you and get you started on that too. So just set up a phone call and we can talk about whichever makes more sense to you and your goals.
So the way how that will be working, you have a form to fill it up, right? What will take, this is the same form which is on the website, streetsmartrei.com/US. You can fill up that form, and after you will be redirected to the page where you can schedule the conversation with our team, with Carl, myself, and then we can have a brainstorming session about your goals, what exactly you want to achieve, how you want to do it, what kind of concerns you have it, and then all those questions will be answered, right? And that's what we are looking towards, to make sure that if you are dedicated, fill up that form, guys. No commitments. We are not giving you, limited time frame and etc. Right? What we want to make sure that we are going to be working with you on a regular basis and build good business relationship. So if you feel like doing that right away, please fill up. Otherwise, you can close it, and then you will be redirected at the end, right? And that's what will be happening. Can you put on another slide too?
Sure.
And if you will miss any questions and something pop up at the conversation, that presentation is recorded and will be available for you anytime to watch. However, if you will be having extra additional questions, we have a technology that you can log into the real estate investing community, right? After login, you go to the discussions, and there is a special group, Canadian Investing in the United States. So you can create a new discussion there, and I'll ensure that Carl or myself or whoever is involved in those operations will answer. So definitely there is no problem about that. And we are not going to finish with this presentation. There will be multiple presentations, and we will be having professionals, accountants, and Carl will be speaking, and maybe we will show different aspects of real estate investing, right? So that's one of the things which I want to ensure you, right? And couple suggestions and make you understand. Carl, you finished, right? No? Yes?
Yep, I'm good. Yep, you bet.
Okay, so one of the things which, if you're thinking about real estate investing, right, people are, and that was one of the questions, people are asking, what's the name of the strategy, right? So not necessarily you have to have a name for creatively structuring the deals, whatever comes through the pipe. If you have enough understanding of what the process is, how real estate investing is working, you can implement different strategies. Doesn't have to be rent to own, doesn't have to be subject to, I'm talking about US or agreement for sale in Canada. What can be done is, as long as you know who the buyer is, as long as you know you have resources, you can structure almost every deal as long as you will have enough information, right? So guys, do not be stuck with the naming of the strategies that may not even exist, but more likely Carl was covering with the wrap mortgages, right, and lending. And if you see on that triangle of the real estate investing, the lending and wrap mortgages is on the top. So what Carl is doing is, what we are doing with Carl is, we are uplifting you in US to the point where you would like to be as a full-time real estate investor, lending, no toilets, no tenants, no headaches. And for $50,000, $60,000, $80,000, below $100,000, you can have a decent ROI, no liability, recession proof, right? That's one of the important things, Carl, right?
Absolutely.
The system is more likely recession proof, right? Imagine implementing this strategy in, I don't know, Vancouver. Can you? Tell me.
Yeah, I would think so. I mean, private lending is you can do anywhere, and owner
Yep.
finance. Jarek, you'd know more about Canadian laws and things like that, but you can owner finance, right?
Of course you can. However, how much return you will have it and how much you have to lend, right? And pay off your WestJet visa, guys, right? Okay.
Yeah, that's the beauty of the US is you can get in so cheaply with buying properties. And that's why I love it so much.
That's one of the things which, guys, if you are interested, don't hesitate, fill up that form. You will be, go back to another slide, you will be redirected after this presentation. After, when you finish, we will send you a sequence of the follow-up emails with the educational resources which Carl recorded and make available. And what we want to make sure that you are well taken care of, guys, okay? If that's what you're looking for, perfect, fine. Any other questions? Oh, Mr. Chow had questions, right? All through your using owner finance value, is it comparable with the fair market value?
Great question. It honestly depends on the property. There's some houses that I analyze under this strategy where the value of the home is actually higher than the owner finance value, okay? Other times I look at deals and the owner finance value is quite a bit higher than the fair market value, okay? And sometimes they're very close. So it just depends on rent and it depends on home values, okay? But the great thing about this is that we are creating value in the marketplace that buyers can't find anywhere else, okay? And that's the financing. If they want to go to the bank, they shouldn't be paying the price. You know, for that example I share with you, they don't want to be paying that price, but we're providing them ownership at an amount that they can afford, that they're already paying to rent. And so that's why you can justify a higher value.
Definitely, there is no doubt about that. There is a couple questions which I had pleasure answering, and I would like to just reinsure. So how much you making on the deal? I believe it that Karen, that's question. I believe it you already covered that, right? You provided numbers. That was what the strategy is being called. I answered is there is no really name on it, but including wrap mortgages lending is as a part of it, right? And then Cho, sorry if I mispronounce your name, Cho, respectfully, I hope you forgive me. Does your private lender normally set up LLC, C Corp, or under individual?
The private lender, what entity do they have? Is that the question, Jarek?
Yes, that's exactly right.
Yeah, it could be, it can really be anything. It could be in a person's name, so individually. It could be in an LLC. If you're Canadian, I think probably a limited partnership. But what I would do is I'd ask a cross-border accountant these questions if you're thinking of getting going. And I'm sure Jarek, me both, we can refer you to some good guys that can help you out there.
We have set up already presentations. We will have accountants taking care of that option, right? And then will be available for anybody who wants to participate in the very near future. We have to set it up the date. And we have a US and Canada known accountants, right? So that's very, I was very happy about that, right? So if there is any other questions, if there is any questions, please just, this is last moment, right? And would you like to provide the contact information, Carl, and then we will wrap up?
Sure.
Okay.
There we go.
But guys, I do really encourage you to follow up with the links, streetsmartrei.com/US. That will track it, and that everything we are organized, automate, and to make sure that you will be not missing any opportunities, right? But feel free to reach out to Carl, investmentpropertyus.ca, Streetsmart REI. There is an email, phone number, right? So, any other questions, guys?
And Jarek, I just want to say, like, if any of you guys have any questions about U.S. investing, feel free to send me an email, because I know that it can be daunting learning a new country, and so definitely reach out both in the forum there and to me, and just start asking questions, because that's the only way you're going to learn is by talking to people that have already done it. And we want to help you guys, overcome some of the challenges and and be able to move faster than what it took us to figure it out. So
okay, I always keep saying the most important thing, Carl, is your family, right? You have to provide for your family, right? You have to be associated with people which have been done it and they know what they are doing, right?
Yeah.
My job is to make sure that I'm not inviting any crooks, scammers, and money getting people. My reputation is very important. That's why I have a pleasure talking to you. We know each other for like 8, 9, 10 years ish, right? You are one of the first members of my organization, right? Many years ago. So kudos for that.
Absolutely.
Okay, so thank you very much. And I will be very, very happy to work with Carl and everybody else. Any other final thought, Carl?
Yeah, well, thank you guys for coming in and sharing your time with us tonight. We love real estate and we want to share this with you guys. So appreciate that, and just take action. No matter what avenue you decide, just start taking action, ask questions, and just get moving. Okay, that's it.
And if you're not going to take an action, I'll kick your butt on a regular basis. Pleasure. Thank you very much.
Thanks, guys.